Disclaimer.
Picture this. You check your silver position on Wednesday morning, January 8th, and watch it drop 5% in a matter of hours, falling to $74 an ounce, while your phone starts buzzing with alerts from every financial news outlet. Deutsche Bank sends a client warning about imminent forced selling. JPMorgan Chase publishes a research note about mechanical liquidation pressure. And Citigroup's commodity desk issues a flash alert about unavoidable index rebalancing. Three of the biggest banks in the world are suddenly telling the exact same story at the exact same time. And if you've been in markets long enough, you know that kind of coordination doesn't happen by accident. Before we dive deeper into what's really happening here, I want to ask you to hit that like button and subscribe to this channel so I can continue my investigative mission and provide even more high-quality content that helps you navigate these financial markets with clear eyes and accurate information. These investigations take time and research, and your support makes it possible for me to keep digging into the stories Wall Street doesn't want you to understand. Here's what should grab your attention. Silver is up 152% in 2025, one of the most explosive runs in commodity history. Yet these banks are warning about a crash triggered by something called the Bloomberg Commodity Index rebalancing. Between January 9th and January 15th, somewhere between $6 and $14 billion of silver positions need to be mechanically sold by passive funds that track this index. And according to the bank warnings flooding your inbox, this selling will overwhelm the market and trigger a cascade of forced liquidation. The timing feels urgent, the language feels dire, and the coordinated messaging makes it sound like you need to exit your position immediately before the floor drops out. But what if I told you that the banks issuing these warnings already executed the exact trade they're trying to scare you away from? What if the crash they're predicting already happened, and the selling pressure they're warning about has been quietly absorbed over the past 2 months by entities who knew exactly when this rebalancing would occur? Let me walk you through what's really happening here, because this isn't just about silver dropping 5% on a Wednesday morning. This is about understanding the difference between paper markets and physical reality, between coordinated institutional messaging and actual supply-demand fundamentals, and most importantly, between being the person who provides exit liquidity and the person who recognizes when Wall Street is trying to shake you out of a winning position. The Bloomberg Commodity Index rebalancing is absolutely real, and yes, it represents significant selling pressure in the paper futures market. When silver surged from $30 to $85 through 2025, its weighting in the Bloomberg Commodity Index ballooned from 4.5% to 9.6%, creating a mathematical problem for passive funds that need to maintain specific commodity allocations. According to the index methodology rules published in October, silver's weighting would be cut back to 3.94% during a 5-day window starting January 9th, forcing passive index trackers to mechanically sell billions of dollars worth of silver futures contracts, regardless of market conditions or price action. Here's where the story gets interesting, though. The new weightings weren't announced yesterday or last week. They were published in October 2025, giving active fund managers 3 full months to position for exactly this moment. While retail investors were watching silver consolidate through November and December, pulling back from those $85 highs down to the mid-70s, institutional traders who manage active commodity portfolios were systematically front-running the rebalancing trade. They sold into strength during October and November when silver was still trading above $80, then waited for the mechanical passive selling to create the perfect re-entry opportunity. Think about what that means for a second. The crash that Deutsche Bank and JPMorgan are warning you about in their January 8th client alerts already happened during the November-December consolidation period. Active managers did not wait until January 9th to start selling. They began unwinding positions the moment those new index weightings were announced in October. The 5% drop you're seeing right now isn't the beginning of some catastrophic forced liquidation event. It's the final stage of a trade that sophisticated institutions have been executing for months, while retail investors watched from the sidelines, wondering why silver couldn't break back above $85. Now let's talk about something the bank warnings conveniently forget to mention. What's happening in the physical market while all this paper shuffling plays out in New York futures trading? On January 1st, 2025, China implemented sweeping new export restrictions that fundamentally changed the global silver supply picture. Under the new licensing regime published by China's Ministry of Commerce, any company wanting to export silver from China must obtain a government-issued license, maintain annual export capacity of at least 80 tons, and demonstrate credit lines exceeding $30 million. These are not just bureaucratic hurdles. They are supply chain barriers that effectively locked hundreds of smaller exporters out of the international market overnight. Here's why that matters to you and your silver position. China is not some peripheral player in the silver market. Chinese refineries and exporters account for 60 to 70% of global refined silver supply. processing ore from domestic mines and recycled material from electronics manufacturing, then shipping that refined metal to manufacturers and investors worldwide. When you cut off 2/3 of global supply with an export licensing system that only the largest state-connected firms can navigate, you create a physical shortage that no amount of paper selling in New York futures can overcome. And we're already seeing that physical shortage play out in real time through a metric that veteran commodity traders watch religiously: the basis between Shanghai physical prices and COMEX futures prices. Right now, today, physical silver in Shanghai vaults is trading at $78 to $80 per ounce, while COMEX futures in New York are sitting at $74. That's a $5 to $8 premium for physical metal. In Asia and in the commodity world, that kind of premium spread tells you everything you need to know about where the real demand is located and where the actual supply shortage exists. Think about what creates a premium like that. When physical buyers in Shanghai are willing to pay $8 more per ounce than the paper price in New York, they're sending a crystal clear message. The metal they need for manufacturing solar panels, electric vehicle components, and consumer electronics isn't available at any reasonable price, so they'll pay whatever premium is necessary to secure delivery. That $8 Shanghai premium isn't speculation or financial engineering. It is industrial buyers and physical investors scrambling for metal that does not exist in sufficient quantities to meet actual demand. So here's the reality check you need right now. Yes, $6 to $14 billion of passive index selling is hitting the silver futures market over the next 7 days. Yes, that mechanical selling creates short-term downward pressure on paper prices. But every single ounce that gets dumped in the New York futures market is getting absorbed by physical buyers in Asia who are paying premiums $8 above COMEX to secure actual metal. The banks, warning you about forced liquidation and mechanical selling pressure, aren't mentioning that detail, are they? This is where you need to make a critical decision about whether you're trading a paper derivative or owning a physical commodity. If you believe silver is just another financial instrument where supply and demand don't matter and momentum can be reversed with coordinated bank warnings and index rebalancing mechanics, then maybe those Deutsche Bank alerts make sense. But if you understand that silver is a physical metal with actual industrial applications, limited mining supply, and growing demand from sectors like solar energy and electric vehicles, then you recognize that a 5-day mechanical selling window is nothing more than noise in a multi-year supply deficit story. The question is whether the Bloomberg rebalancing is real, or whether passive funds will mechanically sell billions of dollars worth of silver futures over the next week. The question is whether that selling matters. When Shanghai physical premiums are $8 above COMEX, when China just cut off 70% of global refined supply, and when the institutions issuing those scary bank warnings already executed this exact trade back in November at much higher prices. Because if you're selling right now based on coordinated bank alerts about mechanical rebalancing pressure, you're providing exit liquidity to the same traders who front-ran this move 3 months ago and are now trying to buy back their positions at $74 instead of $85. Let me be clear about what's happening here. This is not a warning about silver fundamentals deteriorating or industrial demand collapsing or new mine supply flooding the market. This is a coordinated messaging campaign timed to coincide with mechanical selling that sophisticated traders knew was coming since October, designed to shake retail investors out of positions before the selling window closes on January 15th, and the physical shortage reasserts itself in pricing. The banks are not trying to save you from losses. They're trying to scare you into providing them with cheaper re-entry opportunities. Now, let's back up everything I just told you with hard numbers and verifiable data, because the difference between a good story and documented reality is evidence that you can check yourself. We're going to look at COMEX vault inventories, Shanghai physical holdings, the paper to physical ratio that tells you how leveraged this market really is, and the actual mechanics of how this Bloomberg rebalancing works, so you understand exactly what's happening during this 5-day window. Start with the COMEX registered inventories, which represent the physical silver sitting in exchange-approved warehouses that's actually available for delivery against futures contracts. According to CME Group's daily vault reports, COMEX registered silver inventories have collapsed 70% since 2020, falling from roughly 180 million ounces down to around 54 million ounces today. That's not a gradual decline we're talking about. That's a systematic drain of physical metal from the exchange vaults that's been accelerating over the past 5 years as industrial demand surged and investment demand from both institutions and retail buyers depleted available supply. But here's what makes that inventory collapse truly significant. During the same period that COMEX registered inventories fell 70%, the number of open futures contracts representing claims on that physical silver actually increased. The CME reports show total open interest in silver futures, ranging between 150,000 and 200,000 contracts at any given time, with each contract representing 5,000 ounces. Do the math on that, and you're looking at 750 million to 1 billion ounces of paper claims on 54 million ounces of physical metal sitting in registered vaults. That's a paper to physical ratio that's gone completely parabolic. The situation gets even more extreme when you look at Shanghai's physical silver holdings. According to Shanghai Futures Exchange warehouse data compiled by Reuters, silver inventories in Shanghai approved vaults hit 10-year lows in late 2025, falling to levels not seen since the early 2010s, when silver was trading at $30 an ounce instead of $74 today. Think about what that means. Prices have more than doubled, yet physical inventories in the world's largest manufacturing economy have fallen to decade lows because Chinese manufacturers need every ounce they can source for solar panel production, electric vehicle components, and consumer electronics manufacturing. When you combine collapsing COMEX inventories with depleted Shanghai vaults and calculate the total paper-to-physical leverage in the global silver market, you get a ratio that industry analysts at Metals Focus and the Silver Institute estimate at 356 to 1. For every physical ounce of silver that actually exists in exchange vaults available for delivery, there are 356 paper claims through futures contracts, exchange-traded products, and various derivatives. That's not sustainable leverage. That's a Jenga tower waiting for someone to pull out the wrong block. Now overlay that precarious physical situation with the supply-demand fundamentals that have been building for years. According to the Silver Institute's 2025 World Silver Survey, global silver markets have been running deficits for multiple consecutive years, with 2025 showing an annual deficit of 230 million ounces between total supply from mining and recycling versus total demand from industrial applications, photography, jewelry, and investment. To put that deficit in perspective, Mexico is the world's largest silver-producing nation at roughly 240 million ounces per year, meaning the global market is running a deficit equivalent to losing Mexico's entire annual production. You cannot run 230 million ounce annual deficits year after year while COMEX inventories collapse 70%, and Shanghai vaults hit decade lows, and then expect that a $6 billion paper sell program from passive index funds will somehow crash the price and create sustained downward momentum. The physical shortage is too severe, the industrial demand is too strong, and the available supply is too constrained for paper selling to overcome fundamental reality for more than a few days. So let's get into the actual mechanics of this Bloomberg Commodity Index rebalancing so you understand what's really happening during this January 9th through 15th window. The Bloomberg Commodity Index tracks 24 exchange-traded commodities and rebalances annually to maintain target weightings based on liquidity and production data. Silver's weighting in the index ballooned through 2025 as prices surged from $30 to $85, taking its allocation from 4.5% to 9.6% by the time Bloomberg published new weightings in October. According to the index methodology documents that Bloomberg makes publicly available, silver's weight is being cut from 9.6% back down to 3.94%, representing a reduction of 5.66 percentage points. When you calculate how much silver that represents across all the passive funds that track this index, Scotiabank's commodity research team estimates the selling at roughly $6 to $14 billion, depending on how you account for various fund structures and tracking mechanisms. That's real selling pressure, absolutely. But here's the critical detail that puts it in perspective. Scotiabank's analysis shows this represents only 17% of the total open interest in March silver futures contracts. Think about what that means. The massive forced liquidation that Deutsche Bank and JPMorgan are warning you about represents less than 1/5 of the total positions currently open in just the March contract alone, not counting June, September, or any other delivery months. And that 17% isn't hitting the market in one catastrophic dump. It's being spread across 5 trading days from January 9th through January 15th in roughly 20% daily increments, according to the index rebalancing mechanics that Bloomberg published months ago. So on any given day during this rebalancing window, passive funds need to sell approximately 20% of the total $6 to $14 billion amount, which works out to roughly $1.2 to $2.8 billion per day. The March silver futures contract typically trades $8 to $12 billion in total daily volume, meaning the rebalancing selling represents 10 to 23% of normal daily trading volume. That's noticeable, sure, but it's not market-breaking, it's not overwhelming, and it is certainly not the apocalyptic forced liquidation scenario that the bank warnings made it sound like on January 8th. Now let's talk about China's export restrictions, because this is where the physical supply story goes from concerning to critical. On January 1st, 2025, China's Ministry of Commerce implemented new licensing requirements for all silver exports as part of broader efforts to secure strategic mineral supply chains. Under the new system documented in official Ministry of Commerce announcements, companies wanting to export silver must meet 3 specific criteria. obtain a government-issued export license that requires annual renewal, demonstrate minimum annual export capacity of 80 tons of silver, and maintain credit lines of at least $30 million with Chinese banks. Those requirements sound bureaucratic until you understand what they mean in practice. According to Shanghai Metals Market data compiled by Reuters, hundreds of smaller silver exporters who previously shipped refined silver from China to manufacturers and investors worldwide no longer qualify under the new system. These weren't major state-owned enterprises. These were private refineries and trading companies that processed recycled silver from electronics manufacturing, purchased domestic mine output from smaller producers, and shipped that refined metal to global buyers who needed quantities smaller than the 80-ton minimum that large exporters handle. When you lock out hundreds of exporters overnight by raising the capacity requirements and credit line thresholds to levels that only state-connected firms can meet, you effectively nationalize silver export flows and reduce the total amount of metal leaving China by 60 to 70%, according to estimates from commodity trading firms like Trafigura and Mercuria. That's not speculation or worst-case scenario modeling. That's what the initial trade flow data from January showed as smaller exporters were shut out and larger firms prioritized domestic industrial customers over international shipments. The impact of China's export restrictions is showing up immediately in the Shanghai physical premium over COMEX futures prices. Right now, as I'm recording this, physical silver in Shanghai is trading at $78 to $80 per ounce, according to Shanghai Gold Exchange spot price data, while COMEX futures in New York are at $74. That $5 to $8 premium tells you everything you need to know about where the actual physical supply shortage is most acute, and where buyers are most desperate to secure metal regardless of price. Commodity traders call this premium the basis, and when the basis widens to $8 per ounce in a market where total COMEX inventories represent less than 1 week of global industrial demand, you're looking at a supply crisis that no amount of paper futures selling can resolve. Physical buyers in Shanghai are paying $8 more per ounce than New York paper prices because they need actual metal for solar panel manufacturing lines that are running 24 hours a day. Electric vehicle component production that's ramping up across China's automotive sector and consumer electronics assembly that consumes millions of ounces monthly. When Western passive funds mechanically dump billions of dollars worth of paper, silver futures during this January 9th through 15th rebalancing window. Every single contract that gets sold in New York gets arbitraged by physical buyers in Asia who can make $8 per ounce simply by buying COMEX futures, taking delivery and shipping the metal to Shanghai, where industrial buyers are paying premiums. That arbitrage mechanism creates a natural floor under prices because sophisticated commodity trading firms with global logistics networks will step in and buy every ounce of paper selling as long as Shanghai physical premiums remain elevated. Here's the final piece of evidence that proves this sell-off is theater rather than fundamental deterioration. The banks issuing these dire warnings about forced liquidation and mechanical selling pressure are the same institutions that actively trade silver for their own accounts and manage commodity portfolios for institutional clients. When Deutsche Bank sends out a client alert on January 8th warning about imminent forced selling starting January 9th, do you think Deutsche Bank's proprietary trading desk isn't positioned for that exact trade? When JPMorgan publishes research about mechanical liquidation pressure, do you think JPMorgan's commodity traders aren't already positioned to buy into that selling? These banks knew the Bloomberg rebalancing was coming since October when the new weightings were announced. They knew the exact dates, they knew the approximate volumes, and they knew the mechanical nature of the selling meant passive funds would execute regardless of price. Smart institutional traders don't wait until the day before rebalancing starts to position for a trade they've known about for 3 months. They front-run it during the November-December consolidation when silver was pulling back from $85. Then they send out scary client alerts the day before mechanical selling begins. So retail investors panic and provide additional exit liquidity at even lower prices. Now, let's talk about what happens after January 15th, because that's when this entire narrative flips and the mathematical reality of the supply shortage becomes unavoidable for everyone still short this market. The Bloomberg rebalancing window closes on January 15th. That's 7 days from today. And after that date, the last source of scheduled, predictable, mechanical selling disappears from the silver market. No more passive index funds executing predetermined sales. No more coordinated bank warnings about forced liquidation. No more convenient excuse for why paper prices are trading at discounts to Shanghai physical premiums. What remains after January 15th is the underlying supply-demand reality that has been building for years and reached critical mass when China implemented those export restrictions on January 1st. You've got COMEX registered inventories at 54 million ounces, representing less than 1 week of global industrial demand. Shanghai vaults at 10-year lows, with physical buyers paying $8 premiums over New York futures. Annual deficits running 230 million ounces, while paper to physical leverage sits at 356 to 1, And now China has effectively cut off 60 to 70% of global refined supply with licensing requirements that only state-connected firms can meet. Let me walk you through the calculation that tells you where silver is headed once this 5-day selling window closes. Industrial demand for silver is accelerating, not declining, because of 3 massive consumption trends that are still in early stages: solar panel manufacturing, electric vehicle components, and artificial intelligence server infrastructure. According to the Silver Institute's industrial demand forecasts, solar panel production alone consumed roughly 140 million ounces of silver in 2025, and that number is projected to grow to 200 million ounces by 2027 as global solar capacity installations accelerate. Electric vehicles use roughly 1 ounce of silver per vehicle in various electrical components and contacts. And with EV production ramping from 15 million units in 2024 to projected 35 million units by 2027, that's another 20 million ounces of incremental annual demand coming from automotive alone. Then you have the AI server build-out happening across data centers globally as companies race to deploy large language models and machine learning infrastructure. Each high-performance server rack uses silver in thermal management systems, electrical contacts, and various circuit board applications. And with hyperscalers like Microsoft, Amazon, and Google, each spending tens of billions of dollars annually on data center expansion, that's creating industrial silver demand that didn't exist 5 years ago and is growing exponentially. When you add up solar acceleration, EV ramp, and AI infrastructure demand on top of existing industrial consumption from consumer electronics, medical devices, water purification systems, and traditional applications, you are looking at total industrial demand that consumes roughly 600 million ounces annually, while global mine production sits at around 820 million ounces according to Metals Focus data. The gap between industrial demand and mine supply used to be filled by recycled silver and investor selling. But with China, as export restrictions now limiting the flow of recycled material from Asia and investors holding rather than selling, after watching this market consolidate through November and December, that supply gap is becoming unbridgeable. Here's where the timeline gets specific and actionable. The rebalancing window closes January 15th, which means by January 16th, the mechanical selling from passive index funds is complete and done. Any residual downward pressure from that source disappears, and the market transitions back to trading based on actual supply-demand fundamentals rather than predetermined index mechanics. With Shanghai physical premiums at $8 over COMEX and industrial buyers scrambling for delivery, silver has a clear path to reclaim the $80 level by the end of January as arbitrage buying absorbs the remaining paper selling, and physical tightness reasserts itself in New York futures pricing. Looking further out, if China's export restrictions remain in place through the first quarter, and there's no indication they're being relaxed, the cumulative impact of 60 to 70% supply reduction flowing through global markets creates conditions for silver to test $100 per ounce by the second quarter of 2026. That's not wild speculation or momentum-chasing projection. That's basic supply-demand math when you cut off 2/3 of global refined supply, while industrial demand accelerates and available inventories can't meet more than a few days of consumption. The banks desperately need retail panic selling during this January 9th through 15th window because of their own positioning in this market. According to disaggregated commitment of traders data published weekly by the Commodity Futures Trading Commission, swap dealers and money managers hold net short positions in silver futures that analysts at RJ O'Brien estimate at roughly 4.4 billion ounces when you account for both COMEX futures and London over-the-counter positions. That's an absolutely massive short position, representing nearly 5 years of total annual mine production. And as long as paper prices trade below physical prices in Shanghai, those short positions are hemorrhaging money daily as the basis continues to widen. Think about what it means for banks to be short 4.4 billion paper ounces, while physical inventories collapse and China cuts off supply. Every day that Shanghai trades at $8 over COMEX is another day of losses on those short positions. Because sophisticated commodity funds are buying COMEX futures, taking delivery and shipping metal to Asia to capture the arbitrage spread. The only way banks can cover those massive short positions without triggering a price explosion is if retail investors panic during this rebalancing window and provide enough selling volume for banks to buy back contracts at $74 instead of $85. That's why you're seeing coordinated warnings from Deutsche Bank, JPMorgan, and Citigroup all on the same day about forced liquidation and mechanical selling pressure. These are not independent research calls that happen to align. This is coordinated messaging designed to shake retail investors out of positions during the exact 5-day window when passive selling creates the cover story for a sharp pullback. If banks can scare enough retail holders into selling alongside the index rebalancing, they generate the volume they need to cover shorts at favorable prices before the physical shortage forces them to chase the market higher after January 15th. But here's what's different this time compared to previous silver shakeouts. The physical shortage is real. The supply restriction from China is unprecedented, and the industrial demand acceleration from solar EVs and AI is creating consumption that cannot be deferred or substituted. In past silver corrections, you could make an argument that investment demand was speculative and would evaporate during a downturn, allowing banks to cover shorts at lower prices before the market recovered. But industrial demand doesn't evaporate. Solar panel manufacturers can't just stop production because silver drops 5%. EV assembly lines don't shut down because of futures market volatility. And data center buildouts don't pause because passive index funds are rebalancing. The verdict here is mathematically straightforward. If you sell your silver position between now and January 15th because of coordinated bank warnings about mechanical rebalancing pressure, you're providing exit liquidity to the exact institutions who front-ran this trade back in November when silver was consolidating in the low 80s. You're helping Deutsche Bank and JPMorgan cover their massive short positions at $74 instead of forcing them to chase the market at $85 or $90 after the selling window closes. You're giving up your position right before the last source of scheduled selling disappears and the physical supply crisis reasserts itself in pricing. What should you do instead? Hold through the 5-day mechanical selling window, ignore the broker calls and client alerts warning about forced liquidation, and position yourself for the snapback rally that's coming when passive selling ends on January 15th and physical buyers in Shanghai continue paying $8 premiums over COMEX to secure delivery. If your thesis on silver was sound at $85, and if you believe the supply shortage story was real, industrial demand was accelerating, and China's dominance of refining capacity created geopolitical supply risk, then nothing about that thesis changed just because passive index funds need to mechanically rebalance over 5 trading days. In fact, your thesis got stronger on January 1st when China implemented those export restrictions and cut off 60 to 70% of global refined supply. Your thesis got stronger when Shanghai physical premiums widened to $8 over COMEX, proving that industrial buyers are desperate for metal regardless of paper futures prices. Your thesis got stronger when COMEX inventories continued falling, and the paper-to-physical leverage ratio hit 356 to 1, creating a market structure where any significant delivery demand could trigger a short squeeze. The banks sending you those scary warnings about mechanical selling pressure understand all of this better than anyone, because they're the ones managing the 4.4 billion ounce short position that becomes untenable the moment physical supply runs out. They need you to panic and sell during this rebalancing window because they need your exit liquidity to cover shorts before Shanghai premiums force them to chase the market higher. Don't give them that liquidity. Do not panic out of a position because of coordinated messaging that's designed to benefit institutional traders at your expense. The physical shortage is real. China's export restrictions are binding. Industrial demand is accelerating. And after January 15th, the last source of mechanical selling disappears while the supply crisis intensifies. Silver at $74 during this 5-day window is not the beginning of a crash. It's the final opportunity for institutions to cover shorts before the market reclaims $80 by month end and tests $100 by the second quarter when the full impact of China's supply restrictions flows through global markets. The question is whether you understand that opportunity well enough to hold through 5 days of noise, or whether you'll provide exit liquidity to the same banks who have been warning you about forced selling they've known was coming since October.